Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the QQQ Trust, which is basically the ETF that tracks the NASDAQ. Now, I'm doing something very different today. As you can see, my chart is clicking away off to the right here. We're still open for about 13 minutes. And what I'm doing is I'm recording so you can see what's happening towards the end of the day. And then I'm going to talk a little bit about the threat of the diesel shortage. And I'm going to do something extremely different, which is for the very first time, I'm going to show you some of my positions because we've had some questions come up with regard to my forecast. Why do you have upside and downside targets? And last week I did mention that that is to benefit our option traders who are looking to adjust their spread positions. But first, let's look at the Qs. You can see that my target from last week, which is this diagonal line right here, we hit that upside target of 279.61. And today, it looks as though we're going to close with a bullish engulfing candle. Now, be careful with that because 80% of the time, bullish engulfing candles result with prices moving higher after that shows up. But the interesting thing is we have conflicting signals down below. If you notice, we have a drop in volume overall. And in the last now 11 minutes, I do not believe that volume is going to beat yesterday's volume. So we have a drop in volume, which tends to be bearish when the prices are moving up. In addition to that, we had the stochastics right at the sell signal. See how the blue is crossing the red today. It's just very slight, but it is crossing. And down below, while the CCI is heading up, we have a negative divergence. We have a lower high right here as the prices are attempting to match the resistance highs back here. So everything we're seeing now is more or less a contradiction based on the bullish engulfing with the other sell signals showing up. So this makes it a little bit more difficult for us to make that forecast. With that said, let me erase all lines. I'm going to keep my downside target down here. I'll redraw that one, but I'm going to clean up my charts. We could see slightly higher prices next week, again, as a result of that bullish engulfing, but I don't think we're going that much higher. In fact, I think we're going to hit this resistance up here, and then we'll have to keep an eye on the volume. So my upside target is, again, very slight at 385.12, and then I think we're going to start to head lower from there. But we have to wait to see how the volume functions at that particular point. If the volume starts dropping on the way up, then that, again, tends to be bearish. So that is the Qs. And I'm going to show you my Q position and how we've been making money on that. It's one of our best positions. It's a put spread that makes money on the way down. But even on big up days like we see today with the Dow still over 800 points, we're still making money on our put spread. So that's for QQQ. If I take a look at the DIA, that's the diamonds. It's the Dow Jones Industrial Average ETF. You can see we have a nice big green candle today. I said we would go up and then start to pull back. We hit the upside target. Obviously, we blew through that, but we have not yet pulled back. Now, I say not yet because look at that green candle and look at this resistance up at this level. See that? We're approaching a resistance area and the volume is increasing, but if we get a drop in volume on Monday and or Tuesday, which I'm going to forecast right there, we could start pulling back from that resistance point as well. So the diamonds obviously are 30 stocks that are tracked in that ETF and that index, but we have other things going on outside of the Dow. We have a lot of geopolitical tension as we come up into the midterm elections, and that could lead itself into some manipulation, market manipulation. Years ago, before there were even any computers, we had a thing happening where it was called painting the tape. Right? In the early 80s especially, we had people manipulating where they would print higher prices on a particular stock in sequence to give the impression that the stock was rallying, while at the same time they were selling into that rally. And that looks and feels a lot like what used to happen years ago. It feels that way right now. We don't have massive volume on the way up. Basically, what happened today on this rally was news of Apple. We had the largest market cap stock showing positive news and they rally the market. But isn't it interesting how no one's talking about Amazon? Amazon got crushed. I mean, look at this. If you look at the chart on Amazon, Amazon gapped down in a big way, and they're setting expectations moving forward for pretty miserable revenues ahead of schedule. So, we have one balancing out the other, but they're focusing on Apple. And so that's what happens when you see markets being pushed around. Look at that big green candle with higher volume. Yeah, that's Apple. But what happens if Apple next week starts to show lower volume on the way up? That means that's going to be bearish as well. So you have to look at the whole market and understand that we're catering to short-term swing traders that are focused mainly on option strategy. We're not looking to promote day trading in any way, shape, or form. So for those of you that are looking for short-term directional trades and forecasts to fit day trading, that's not where we're moving. I'll show you how relaxed of a position we actually keep. And it's pretty exciting. So here is now the chart of the spiders. We have very close to a bullish engulfing, although it's not. Very slight drop in the volume from yesterday. I said that we would move up to this resistance. We did that. Now we parked ourselves more or less at that new support level. Now I'm going to keep that downside target in mind, but I'm going to draw this for next week. Ready? Again, slightly higher, and then I think we're going to start pulling back. My longer term downside target is going to be down here below these lows from early in October. So I'm going to put that right there. That's where my longer term target is. And notice where that price is, right around 350 on the price axis right here. So keep that in mind as I show you my spreads and what we're looking to do for SPY. So now that brings me to the VIX. And this is, in fact, the most interesting chart that we're going to look at today. I did say that the VIX would drop early on. It did that, but it kept going. Count the number of candles right here. We have 10 red candles in a row. That's sign number one you have to watch out for. That's called a stale red light. We're long overdue for a green. Now, could we go a little bit lower? Yes. In fact, I think we will go a little bit lower next week, maybe on Monday. But then you have to consider the fact that we have a wide divergence from the price and that moving average. It's called the rubber band effect. So there's a greater chance that the price of the VIX is going to be brought up to that moving average, and then we have to see whether or not the moving average holds as resistance. So again, what I think we'll see on Monday is a very slight drop, and then I'm going to storm that right up to the moving average. I think that could be a pretty significant snapback to the moving average, at which time that would put downside pressure on the market. Notice where I'm going here with that timeline. Notice the date there. That ends right around November 9th. And what do we have coming up? We have the midterm elections coming up, folks. So this is going to be very, very interesting as we move into this next couple of weeks and getting closer to midterms, because there's still a lot of that, what I said, painting the tape. And every politician that's out there right now would not want to see a drop in the market. That would affect their chances of constituents voting for them. Obviously, everyone wants everything to be rosy right up to the elections, especially the incumbents. But we'll have to see. Again, that's very hard to predict on the political side. And right now, with the way the VIX is looking very bullish. But over time, if the VIX snaps back to that moving average, that's going to put pressure on the S&P especially. Now, if we look at IWM, this is the small cap stock. This is not looking as bullish as the other stocks. Remember, I said we had a chance to go up. My forecast right there was 175.66. We hit that and blew through it. But look, we have that candle right there ending right at this high right there. Very close to that, pennies away from that high. So for the IWM, because we have a very slight increase in that volume, I think we could go up just a little bit, and then we'll start to pull back just like that. And why do you think I dropped that line right there? Because if you look back to the left, we had a resistance point here that was broken right here on this green candle, and that is what's known as a role reversal. When resistance is broken, stocks generally pull back to a new support level. So that role reversal is pretty much where I dropped that line. So upside target on IWM, again, let me get that little data box to come up right there. That is 184.36, and then right back down Again, right around election day, a 177.35. Look down below. You have the stochastics down here starting to hinge. See how it's turning a little bit to the sideways motion? And then we have, believe it or not, even though the IWM is up, the CCI is still going down. That's a negative divergence. And so that is the markets as we look at them. And as we come into the close, right now we're mere seconds away from that bell ringing. I'll then move to our geopolitical report. That will be an opportunity for those of you that want to just focus on charts and charts alone. You can bail out at this particular point in time, and then we're going to get into the news that I do believe is going to affect the markets in a pretty big way. And there you have it. The markets are now officially closed. The Dow closed up 828 points. And now let's talk about what's happening around the world. Remember last week I showed this slide. I said America is going to shut down if we shut down, referring to the Mississippi River water levels near record lows. Well, guess what happened this week, folks? We have a dead in the water situation where the barges are drought stricken. Now, think about this when we talk about supply chain issues. This is most definitely going to affect rice and grain and agricultural products, but there's a lot of other things that come down that Mississippi River. So if we have a supply chain shortage caused by this, which is obviously a natural disaster, you combine that with what we could be seeing, and guess what? The diesel market. Now, you might have to ask yourself this question. Why is this not top of the line news every single day? If we run out of diesel, I'm going to tell you this right now, folks. If we run out of diesel, we're in a heap of trouble. Now, this report went out on October 25th. So now we have 22 days left of diesel supply. And if you think that's bad, look at this chart right here, because this was taken as well. And now we are now right at that low from 2008. Now, again, ask yourself another question. What will happen if we actually do run out of diesel? Well, the trucks aren't going to roll to the supermarket. Airplanes aren't going to take off to load up the passengers because jet fuel and diesel is very closely related. And so if we run out of diesel, you're not going to have the support trucks for the airports. You're not going to have fuel for the locomotives that drive all the freight trains. You're not going to have the tractors running to harvest our food. I mean, it's just one after the next of a domino effect that will lead to an absolute tragedy in our country. Again, why are they not talking about this? Well, it could be because if they make this headline news, it could spark a run on the supermarkets. It could cause a panic. And therefore, they may not be talking about it for that reason. It's hard to say. But you have to ask yourself, what happens if we do shut down? Well, this is something that I do know a lot about. I may have mentioned this on a prior webinar or maybe a broadcast in the past, but years ago, my family was one of the largest heating oil distributors on Long Island in New York. And so my brother and my mother at the time were partners. My mother has since passed, so the company doesn't exist anymore, but I know a lot about this. This is one of the very rare times in history where New York is actually putting on the brakes and forcing the companies to ration the heating oil. Again, this is something that you're not going to see often, if at all, ever again. We'll have to see. Hopefully we won't. But this is right before the peak winter months. So keep your eye on that story. This came out through Bloomberg. Again, it came out on the 21st of October. Here's a post out of Twitter. All right, looking at what's happening within the industry and how they're looking at a possible diesel shortage, absolute disaster. Now, let me explain this to you. I'll take a little time on this one. If we have 22 days left of diesel, this is the area where they're talking, the refinery storage. Now, if you're following the story about our strategic petroleum reserves, understand this. Joe Biden has been selling off the strategic petroleum reserves to China. China refines it and sells it back to us. Isn't that interesting? So the oil that we are importing at this particular point in time is our own oil. It's just being refined. So it's cutting out the refinery process here on refinery A and going straight into a refinery storage. Now follow me here. We do not have the lease agreements in place, nor do we have our own pipeline running. So our domestic oil is cutting short here. And the remaining oil that we have coming in from OPEC is also experiencing a cutback. So there you go. At the top of the chain, we have trouble. No doubt about it. Now, getting to this area right here, if we have 22 days left, there's still oil in shipment on its way to the gas station. From the refinery storage to the end line consumer at the gas station, you have about 7 to 10 days left. Once the oil refinery storage starts running empty, I believe that that's where the panic is going to start to roll in at that particular point in time, and you're not going to have much time. What's that going to do to the market? I believe it's going to cause a panic in the market as well. These are my opinions based on what I'm seeing, mind you, and the technical analysis that I'm seeing absolutely supports the articles that we see coming in through these channels, especially Bloomberg and some of the other financial publications. Now, if you feel a little spooked, don't worry, because we have a plan. And here's where I get into our actual positions. Again, this is the first time I'm actually showing what we call the trade blotter. It's something that goes out normally just to our members, but these are trades that are already done, so I'm not giving away any of the value that our subscribers pay for. But I just want to explain this to you, and you don't have to know a whole lot about options. Just understand this. On August 10th, we put out an alert to buy puts. I'm not going to get into the minor details of this, but when you buy a put, you want the market to go down. So we bought an asset that is worth money. Obviously, at the time, we spent $43. But then simultaneously, what we did is we collected cash from the market in a shorter term put, and we collected $1.82. Now I'm going to fast forward this model to show you what we've been doing since August 10th. Each time we get to the date where it's time to roll the short side, meaning that the options that we sold eventually expire, we then roll those positions into another option that allows us to collect another net credit. And we continue to roll and roll each month for credits until we get to a point where we're able to pay down our cost basis. That's as far as I'm going to go. If you're asking me questions about options in the comment field, unfortunately, I will not be able to answer those because that's reserved for our member page. We have a Q&A form on our member page where I answer those questions about particular positions. But here's the bottom line. Again, what started out was with a $43 debit for that put. Because of the credits that we've been able to take in, we've lowered the cost basis of that position to $38.23. Now, mind you, this does not include the commissions paid because it's hard to know what people are paying in commissions. It's the general price at the time the alerts went out. Okay, just to be clear on that. But for the most part, the cost basis on that spread has been paid down close to $38. Well, interestingly enough, today, as we close the market, this put is now trading for around $65. In a week and a half, this put, which is basically out of the money, will most likely expire worthless, at which time we go in and sell another put in December. And at that point, what do? We pay down that cost basis even more. So as of today, the 28th of October, we have an unrealized profit on this of 60% since August. Now, that's just with our Q position. So when people say, why are you going up and down on your targets? Oh, you can't lose when you do that, or you're never going to win when you do that, whatever the perspective is on that. This is why I put upside and downside targets to benefit our option traders, because if I have a downside target showing support, the option traders are going to know where to roll that next option. You see, we want the market to go down, and in a spread such as this, we want the QQQs to drop as close as they can, get to 270, and then we'll roll out for another big fat credit. That's the goal. And most of the time, we are able to collect credits month after month after month. So remember, we have a decaying asset on the long side, but we're picking up a whole bunch of premium on the short side. This is another example of what we did in SPY, starting on September 8th when that alert went out. We bought those puts for $49.50. Because of the credits, we have a cost basis now of $43.80. Well, where are those puts trading for now? $53. So we have an unrealized profit on that one of 20% since September right there. You see how that works? Now, of course, this isn't a guarantee, but what I'm showing you is that even with a put spread that's a bearish position, we could still make money if the markets rally. Remember, today, the Dow rallied over 800 points, and our positions are still making money for us because, again, in a week and a half, even if the markets go higher from here, we're going to be able to collect dollars on each one of these spreads that we have, which is going to continue to pay that cost basis down to zero. It's not uncommon for us to do a position like this, keep rolling for cash, more cash each month, and paying down the value of these puts or the cost of these puts down to zero. Once we have a zero cost basis, there is no risk on that. Look at IWM. We paid $25 for that option. And guess what? It closed very close to $25. You say, well, you're not really making money on that one. Ha ha, right? Well, guess what? We are making money on that one. Ha ha, right? Because we're collecting credits to pay down the cost basis to $20.47, which has now got us in a position with an unrealized profit of 18% since August. How many investors are out there are up this year on their trades, especially the buy hold folks? How many of you are making money in this bear market? I have to say, the people I talk to that are in the buy and hold camp are not doing very well with their overall positions. But the option traders, and a lot of them are making comments in the comment field below this video, you'll see there's the proof right there. I'm not paying people to make positive comments on the service. No, they do that on their own. We don't solicit anybody to do that. That's all voluntary, of course, all unsolicited. So what I'm going to do next week is I'm going to show you what we will be doing with these positions. I'm taking this market report to a whole different level, and I want to make it a little bit more educational, but I have to be careful because the paying members, I'm not going to give away the good stuff, obviously, on a free market report, but I want to enlighten everyone and expand their horizons so they could see how even in a bear market, we can make money. And in that bear market, even when we have bear market rallies, we could still make money. And that's why my forecasts are up, down, and sometimes sideways. Now, that's my weekly market report. I hope you enjoyed this one. I really am having a great time, folks. I am having such a great time presenting the folks, our members. I do webinars. I do seminars. We do live events. There's an event coming up in Miami. Stay tuned at the very end. It's a very short promo on that one. It's a very small group of people that will be meeting in Miami. We're going to have a great time. We're going to be doing a little cruising, a little live trading. And this is one of my favorite events because this is in our home state of Florida, and people fly in from all over the country. Again, see that little pool right there at the top? That's where I plan on winding up at the end of the day after we do some trading, to meet with our members, have a couple of drinks, relax, talk about the market, and then make sure that we're all on the same page, especially when it comes to technical analysis and option trading. So thank you so much, folks. Have a good weekend, and we'll talk to you next time. Bye-bye.
Introducing our new series of intimate in-person trading conferences in some of the greatest cities in America. It's Market Rebellion Live. First up, this December in Miami. Level up your trading with help from Pete Nigerian, AJ Monte, Ryan Mastro, and Bill Johnson. Miami is limited to just 25 seats to ensure every guest gets personal attention. So act now. Tickets are going fast.